This is how to handle the trading of old equipment for new equipment, and what you do if there's losses and gains, and there's with or without commercial substance related to the equipment you were trading. Let's first start out with some basic information. This is kind of the general information you're going to be given. You want to kind of pay attention to make sure you've got it organized correctly and you correctly identify what is related to the old machine and the new machine. So for this example, the old machine was on the books at $15,000, that must be its historical cost, and it had accumulated depreciation of $8,000. So that gives $7,000 in a net book value of the machine. The fair value of the machine is $5,000. Well, right off the top, that tells me that if it's on my books at $7,000 and it's really only worth $5,000, that I've got a loss of $2,000 that I'm going to have to deal with. So, first things first, I'm always going to record my losses, so I need to make sure I put that aside and I take care of it. Now, there's a new machine I'm buying. The new machine has a list price of $20,000 and a trade-in allowance of $9,000. Don't get hung up on the trade-in allowance being the amount that's valued, the fair value of the old machine. It's not. It's a combination of the discount for the sale and the value of the old machine and other things combined. So you want to make sure you're aware of how all of your costs are coming into play. The value of the new machine is the fair value you've given up or received, whichever is more identifiable. So we know that we've given up a fair value of $5,000 and a cash of $11,000. Because if my trade-in allowance is $9,000 and the price of the machine is $20,000, then I must have to pay $11,000 in cash. So I've got the value I've given up of $16,000 is the total price I've given up. Don't forget that you've got this $2,000 loss that you want to make sure you take care of. So we're going to start things off with just some general ideas. Before we put numbers to the place, we know that we've got to record the $2,000 loss, and we know the value of the new machine has got to be the fair value given up because it's pretty identifiable of $16,000. So now we're going to put that into our journal entry. Start with what you know. You know that you have to record a new asset. So you know you're going to debit equipment. You know you need to get the old equipment off the books. So you know you're going to credit the old equipment and debit the accumulated depreciation. I like to keep this middle part of the entry open. And then if it's going to be a debit, I've got a loss. If it's going to be a credit, I've got a gain. So I know right from the start that I've got those items, equipment accumulated depreciation and equipment on my books. I know I record a loss because I record all losses. And then because in this situation I spent cash instead of received cash, I know I'm going to have a credit. So if I just go with this basic information, I'm just going to add the new information or the numbers and prove that my journal entry balances. And that's what happens. I know the value I've given up is $16,000. This is given of the $8,000 in accumulated depreciation. The equipment of $15,000 is given. The $11,000 here that I had to pay in cash, I've already calculated. And we know that we have a loss of $2,000, and again, that's because the net book value of the machine is $7,000, and that the $5,000 is its fair value, so the difference means I had a $2,000 loss. So everything that I need to account for is here, and it's all accounted properly in the journal entry. Now let's change this just a little bit. If we make the fair value of the machine $8,000 instead of $5,000, we're going to adjust it. So we still have a net book value on the machine of $7,000, but now I have $8,000 as my fair value, so I know I have a gain of $1,000. So how do I treat that gain? I'm going to treat it differently if I have commercial substance or I don't have commercial substance. So I still want to kind of put that gain aside, just, for when I get that commercial substance issue to deal with. The other thing I want to know is, how much am I going to pay in cash? Well, same things. List price is 20, trade-in allowance is 11,000 or 9,000, so I must pay 11,000 in cash. And then I also know that I'm going to record the new machine at the fair value given up or received, whichever is more identifiable. In here, though, if the deferred gain's kind of going to play in here if I'm going to defer a gain or not. And if I am deferring a gain, then I haven't given it up yet. So I'm going to have to subtract that out. So we're not playing with your definitions, we're just adding more things for you to think about. So those are the basics of the computation. What do I have that I've given up? Well, the fair value of the old machine's $8,000. Cash paid is $11,000, so the total given up is $19,000. We still have the gain of $1,000 that's hanging out, deciding whether or not we're going to deal with it. Does this thing have commercial substance or not? Well, if we take the example with commercial substance, then we have a gain. Because a commercial substance is, if the purchase of equipment or the trade or the bringing in of new equipment is going to bring out an increase in cash flows to your company, if you're buying something that's going to increase your cash, it's certainly going to help you. So you're going to have the ability to pay tax on it, and you're going to have the ability to show it now as a gain. If it doesn't have commercial substance, it's not going to help your cash flow. So if it's not going to help your cash flow, it doesn't seem to be fair to have to record the gain now, because then you're going to have to pay tax on it, and you don't have the cash. So without commercial substance, we're going to defer the gain, but I'll get to that in a minute. With commercial substance, we're just going to record everything that we've talked about so far right here. We're going to set up the problem the same way. We know we have the new equipment, so we have to debit it. We know we credit the old equipment and debit the old accumulated depreciation to record that. We know we're paying cash, and we know we have a gain. Well, if you think of expenses always have debit balances, then so do losses. Revenues have credit balances, so do gains. So all you have to do is plug in your numbers, and you've got your journal entry if the problem or if the equipment has commercial substance. Now, without commercial substance, all we have done is taken the total given up of $19,000, subtract the $1,000 deferred gain, and you're left with, you really only gave up $18,000. So our journal entry is only for $18,000. Things different on this journal entry is the equipment value is different, but I'm still debiting equipment. I'm still crediting the old equipment and debiting the old accumulated depreciation. And I'm still crediting the cash, so that hasn't changed. The only part of the entry changing is there's no entry for the gain, and the equipment's decreased. But this actually makes sense. If I've given up $19,000 in fair value, then the new machine has a fair value of $19,000. If I were to turn around and sell that machine for cash today, my net book value, because I haven't taken any depreciation, is $18,000, and I would immediately have that $1,000 gain. But what I've done is I have deferred the gain. So if I were to sell it, I'd pick up that $1,000 gain, and that's how I've deferred it to the point of sale. And the way we've deferred it is this business here of subtracting fair value given up less deferred gain. And that's how you're going to record things that are without commercial substance.